Hi, this is John Coumarianos with Mindful Advisory, bringing you a new edition of Driving Returns. Three items up this week. The first one, U.S. stocks look very expensive on an important metric. Second item, solar stocks and alternative energy stocks have had a very bad run for a number of years. They might be worth a look. Third, beware of macroeconomic forecasts. We'll get into that in a bit. First up, stocks look expensive on something called the Shiller PE. What the heck is a Shiller PE? It's named after Robert Shiller, Nobel laureate economist at Yale. He took this idea from Benjamin Graham, who was Warren Buffett's teacher, and that is to take a normal PE ratio, a price to earnings ratio. That is, what price are you paying for the stock relative to what earnings or profits the stock or the company is producing, but make that earnings part of it, the denominator part of it, not last year's or 1 year's earnings, but the last 10-year average earnings, and then do an inflation adjustment as well. So last 10 years, real or inflation adjusted average earnings. That's what the Shiller PE is. How much are you paying for that denominator, the past 10 years average real earnings? We have a whole history of it. Robert Shiller has compiled a whole history of it from 1880, data beginning in 1870. And the average over that whole period of time is about 1617. From the beginning, from 1880 to 1990, it's about 14.6. And then from 1990 to the present, it's about 26. So a massive jump in the past few decades. Many arguments as to why. Maybe stocks deserve to be higher. Maybe that initial Shiller PE of 14.6 from 1880 to 1990 was too low. But we're at 34 now. We're above even the average well above even the average since 1990. So U.S. stocks look expensive. I don't think there's a country in the world, save Denmark for some reason, that has a Shiller PE right now as high as the U.S. So not an argument for selling all your stocks or even selling all your U.S. stocks, but maybe think about how well diversified you are in foreign stocks. No one can predict that foreign stocks will outstrip or outperform U.S. stocks over the next decade, but it's probably reasonable to have some of your stock allocation in foreign stocks, given how expensive U.S. stocks are. Okay, second up, we're looking at the Invesco Solar Energy ETF, ticker symbol TAN or TAN, very cute. One thing that's not cute about this fund is the fact that it's lost 60% cumulatively since 2021. That's a very big loss. I haven't done much investigating to know if I think, to know or to think that solar stocks or alternative energy stocks are cheap, but that is a really big decline, 60% over a few years. That's got to get your attention, maybe worth investigating. Third, can't help but notice that the word hike is making its way into the economics lexicon now. Hike is in if the Federal Reserve will hike interest rates. Nobody, to be honest, is seriously thinking that that's going to happen. But it's interesting that you're starting to hear that word a little bit more. We came into the year with almost everyone assuming the Fed would cut interest rates 6 times, 1/4% each time, or cumulatively a percentage point and a half for the year. Now, not only do you not have people predicting cuts, but you're starting to hear the word hike, although no serious prediction of it yet or forecast of it. So it just goes to show you how hard uh, macroeconomics is, and maybe that you shouldn't pay attention too much. Best thing to do is to get in touch with a good advisor, set up an allocation that's reasonable for you, and stick something that you can stick with through thick and thin. If you have questions about investment management or financial planning, don't hesitate to call us at 201-951-3509. Again, 201-951-3509, or visit us on the web at mindfuladvisory.com. Again, this is John Coumarianos signing off for Mindful Advisory and for Driving Returns. Have a good rest of the weekend. Have a great week ahead. Thank you.